How to invest with no money. You've probably heard of hedge funds and other unique investments that only the rich can invest in. Chances are, hearing about these investments makes it seem like you must have a lot of money to start investing money. In fact, 62% of people think you need $1,000 or more to open an investment account, according to a recent Finance Buzz survey about investing habits. Thankfully, that isn't the case. You can start investing and building a nest egg with just a little money. Here are 10 smart small investments to consider if you're ready to make some financial moves. Let's get started. Number 10. Open a retirement account. You can start saving for retirement by opening a retirement account. Most retirement accounts give you some kind of tax break to encourage you to save now for your future. For example, you don't get a tax break today if you have a Roth IRA. Instead, you can take the money out without paying taxes on it when you retire, as long as you meet the requirements. On the other hand, if you have a traditional IRA, you may be able to get a tax break right now. When you take the money out, you have to pay taxes on it. If you take money out of either account before you're 59 and a half, you might have to pay a fee. Be sure that you can invest this money for the long term. In the end, the type of account you choose will depend on your goals and current situation. Number 9. Invest in an index fund. You have to decide whether to put your money in a taxable investment account or a retirement account. You might want to add an index mutual fund to your portfolio of investments. An index mutual fund is, in essence, a single investment you can buy. It has a number of investments inside. The goal of these investments is to get the same returns as an index, like the S&P 500. Investing in an index fund has the advantage that you don't have to buy a share of each stock in the index. Index mutual funds may require a minimum investment to get started, but there are also many that don't. Fidelity has a number of mutual funds with no minimum investment, such as FNILX, FZIPX, FZRLX, and FZILX. Number 8. Diversify with an ETF. Exchange-traded funds are something else that small investors can do. ETFs are like mutual funds in how they work. One big difference is that you can trade an ETF at any time during the day. Mutual funds can only be bought or sold once a day. Like mutual funds, ETFs can help you spread out your risk so you don't put all of it in one stock. AX might also sometimes have lower fees. They only let you buy one share of the ETF with the money you have. If a company lets you buy fractional shares, this limit might not be in place. If you want to invest in ETFs, you might want to open an account with Stash. You can invest in stocks and ETFs with this service, and you don't have to put a certain amount. For its service, Stash does charge a monthly fee, but it starts at just $1 per month. Number 7. Purchase fractional shares of stock. Even if you don't have a lot of money, you can still buy stocks if you want to pick the companies you want to put your money in. You could buy fractional shares of stocks and ETFs through a number of new investing apps, such as Robinhood and Stash. Instead of having to save up $1,000 to buy one share of a popular technology company, you can buy 001 shares of the company for $1. This makes it easy to spread out the stocks in your portfolio. With fractional shares, you can buy a small amount of stock in a number of different companies. If you didn't have a lot of money saved up, it would be hard to do this with whole shares. Number 6. Get started in real estate. Most people think that in order to invest in commercial or residential rental properties, they have to buy the whole building. This could cost you at least $100,000. Using real estate crowdfunding companies like Diversify, you can start investing in real estate with much less money. If you want to invest in Diversify's Diversify Growth or EID, Real Estate Investment Trust, you can start with a $500 investment. The company takes the money invested by many people and uses it to buy real estate. With this investment, the goal is to fix up and move some properties so that their value goes up. Number 5. Put your money in a CD account. The best small investments don't always have to be traditional ones like stocks or bonds. A bank account can also be a good choice. Certificates of deposit are a simple way to put your money to work. When you buy a CD, you're telling the company you're willing to leave your money with them for a certain amount of time. In return, the company gives you a set amount of interest. This could be a good choice if you know you will need the money at a certain time in the future and can't afford to lose any of your investment. Since the interest builds up, you can earn more interest on the interest you've already made. CDs are usually covered by insurance from the Federal Deposit Insurance Corporation or the National Credit Union Association. This gives you peace of mind because you know your money will be there when the CD comes due. Number 4. Look into a money market or high-yield savings account. Consider a money market or high-yield savings account if you don't want to put your money away for a certain amount of time, but still want a higher interest rate than a checking or savings account. Even though interest rates have been going down in general, these accounts could be a good way to save money when rates start going up again. There may be a minimum deposit needed for some money market accounts, but this varies by bank. Make sure it won't be a problem before you try to open an account. Number 3. Let a Robo advisor do the heavy lifting. If you do not already have a sizable amount of assets under your control, it is not recommended that you seek the assistance of a traditional fiduciary financial advisor unless you are willing to pay a fee for their services. Within the last decade, a number of brand new businesses, which are referred to as robo-advisors, have begun operations in order to solve this issue. Robo-advisors are financial services that leverage technology to help clients build diversified investment portfolios. Instead of having a human financial advisor do the work for you, the technology works to keep you on track with your goals so that you can save time and money. Portfolios for robo-advisors are sometimes constructed by human financial advisors. After that, you select one to invest in based on the goals you want to achieve and the amount of risk you are willing to take. Number 2. Get started with micro-investing. Micro-investing enables you to construct the foundation of your investment portfolio with recurrent investments of the smallest possible sums of money. The Coin is a popular app that enables users to invest their spare change by rounding up their purchases to the nearest dollar. You select one investment strategy from several different ETF portfolios, each of which was developed with the assistance of a Nobel Prize winner. After that, the amount of shares you own will continue to increase with each investment. When a payment card is linked to the app will automatically round up each transaction to the nearest dollar. After reaching a threshold of $5, your spare change will be placed in the investment of your choice. The monthly fee for the service ranges from $1 to $5, depending on the option that you select. Despite this, it is a fantastic method for getting started in the world of investing with money that you won't even miss or realize you have. Number 1. Invest in your peers. Traditional financial assets such as stocks, bonds, exchange-traded funds, and mutual funds don't work well for everyone. Lending Club and Prosper could be better options for you if you would rather invest your money with other people than in the stock market. These businesses facilitate the connection of individual borrowers with those individuals who are willing to lend money. This type of lending is known as peer-to-peer lending. You can make an investment in a loan to a borrower with as little as $25. The peer-to-peer lender hands over the funds to the borrower once sufficient funds have been contributed by other individuals to cover the cost of the loan. The peer-to-peer lender will then collect payments, which will typically include interest, and will send those payments to you. Your ability to get repaid is contingent on the borrower continuing to make payments. Your investment is at risk of being lost if they are unable to repay the loan. Depending on what you want to accomplish with your money, the potential return on your investment might be worth the risk. You don't have to have hundreds of dollars sitting around to start investing. Thanks to technology and innovation, investing today is more accessible than ever. Now you know you can invest with small amounts of money. It's time to start working toward your personal finance goals. Just keep in mind that no investment is risk-free.